Welcome back. We are here to present the 17th edition of our stock recommendations, stock reviews, and market outlook. Market outlook comprising Nifty, Bank Nifty. This week, we are doing some changes. We have been reviewing those sectoral indices, and a lot of people have actually told me that instead of sectoral indices, if I concentrate more on actionable things, that means they require more review of individual stocks. To cater to that demand, we are actually going to do that. This time in our stock reviews, as we said, what we are going to do in these stock reviews would be that we are trying to situate the stock in the current moment at the end of the week, and what the stocks have done, and whether there is any upside potential, or if it were to be, it would be going down, then where the supports would come. We would discuss it. We are not going to give any recommendations, but definitely the nature of the stock, whether it is bullish or bearish, where the supports and the resistances could be, we would discuss that. So see our stock review. So we start with Cipla. Cipla had been on a dream run since the beginning of April. It was mid-March and late April kind of thing, from where it was below 900. From there, Cipla has been moving up, and Cipla posted a high 3 weeks back around the level of 1257. 1257 was the high. From there, in fact, 1277 has been the high. From there, it has started underperforming, and it is not exactly an evening star, but it is a kind of a black body and then a large red body. It is a bearish formation. After forming that high of 1277 3 weeks back, the last couple of weeks had been somewhat weaker, because there are two red candles and they show that a lot of selling has been happened. Selling has taken place, and now even the 14-week RSI is now trying to go below the 70 mark. It has it has closed at 72.78. Chances are it will fall below that. So it is better to book some profits in Cipla, despite the fact that it has posted an all-time high and the movement has been pretty good. Moving averages are showing that going forward there would be further rise, but one thing is certain: there would be an intermediate term correction in which Cipla, at least I envisage that 1177 and 1145, these two levels might well be scaled up or scaled down, and they might be reached. So now that it is at 1209, if you can enter around, say, 1145 or even lower, or at least partly book your profits, then that would be a good thing. So no fresh long positions in Cipla right now, not before it tests about 1150 kind of levels, plus or minus 5 points out here and there. Maybe around that time you may contemplate to getting to Cipla. Again, yes, there will be another round of upswing, because the 9-week, 20-week and 50-week moving average bullish crossovers are likely to taking place. Once that happens, there would be a good upswing. So go for Cipla, not right now, after the correction. Now you book your part profits or full profits as you so desire. Our second stock under review is Exide Industries. Exide Industries, again, just like Cipla, it has also a dream run. Dream run in the sense that this run began around 27th of March, and the price low at that point of time was 169, and It closed that week at 176, signaling that there could be a recovery. From there, it was a huge upswing. There had been 2 or 3 weeks of correction, but otherwise, more or less, it was going up and up. Now, it has hit a speed breaker around the level of 273. From there, the movement has been on the way down. Finally, uh, after posting a low of 256.85, the weekly close had been at 259. 259. This is a variation of an evening star formation. A long white candle or a long green candle, then you see a small red candle at the top, and then there is another candle, that is the latest candle, that is a red candle. Of course, the high is much higher than the other two, so not exactly a classical evening star pattern, but it is an evening star pattern on the weekly chart that suggests that Exide's run is over. It is going to test the 9-week moving average, which is 9-week moving average is located at 251. From there, it can fall even further. My understanding is that uh, this Exide can actually fall initially to say something like 239. It can even fall further. It can fall to something like 220 kind of levels. So book your profits, get out of this position, or if you do not have, then if you think of getting into Exide, don't do so unless it falls below 250. Better still, it comes close to 220, that would be a good buying opportunity. So if you have Exide, get out of it. Otherwise, keep watching. This could be a good opportunity when the downside correction is through. Our third stock under review is Coforge, which we have given a buy call much earlier. Coforge is currently at 5,200. When we recommended it, we actually suggested 6,000 kind of levels. That time, people were not even projecting 5,000. Now, there is an FII that has re-rated it, and the re-rating up to 6,200 levels. So we are vindicated. Of course, why do we have so much of confidence that Coforge is going to hit 6,000 or higher levels? Look at the volume figure on the chart. This is the weekly chart, and there the volume figure shows that 24.819 million. That means 2 crore 48 lakhs 19,000 shares have been transacted during the last week. So for a stock like Coforge, that is pretty huge. What are we banking on? We said there is a saucer pattern, and the saucer pattern high earlier that is still the all-time high, 5978. I'm also expecting that it is going to get past that. This 5978, it will move up to 6,000 or maybe 6,200. Coforge is now going to go up. It has so much of interest among traders. So if you have bought earlier, continue to hold on. That is our suggestion. If you haven't bought, any dip you should be buying, because over a period of 1 year or so, there is going to be a good appreciation. That is very likely. That's what we tend to think. Our fourth and final stock review is on Pidilite. Pidilite has posted a tweezers bottom on the weekly chart. Last week it was 2470 was the low, and this week the low is 2472. And after posting a 2472 low, Pidilite has closed at 2527. Of course, there is a bearish crossover there, and that bearish crossover is happening around the levels 2561 and 2556. So we need to, that's why we say that if Pidilite were to move above 2565 and sustain there is likely to be a good movement on the upside, and that movement can be a pretty good movement. In this movement above 2565, if volume based buying tends to happen, sustaining above 2565, it might just scale up to 2650 to 2695. So watch Pidilite, see if it is able to sustain above 2565. In that case, there could be a long trade, and the long trades upper direction or upper target could be 2650 to about 2695. Hey, did you like my presentation? If it is so, please press the like button. Subscribe to my channel. Don't forget to press the bell button. The bell button gives you the notifications from YouTube whenever we post a video. Nifty this week began with a promise. At least there had been that kind of a situation which told us that probably it might try to move up, because we have seen a downswing that lasted for about a month, from 20th July to about 21st August. On all of these days, during these 1 month period, what we have seen is that the Nifty has actually slid down. This is a healthy correction. We are not saying that this healthy correction is already over, but there are some signs that suggest that it could be over. This is the 5th week for which we have seen red candles. That means the close has been lower than the beginning of the week. So this is quite a weak prognostication that can be made by this 5 consecutive red candles, that is 5 consecutive bearish candle, but the 5th one is a gravestone doji. Normally after a downtrend, even if it is a short-term downtrend, if there is a gravestone doji, it gives rise to at least some kind of a probability that it could form a temporary bottom. Although the closes had been pretty weak, but the Nifty has not breached the 9-day or 9-week exponential moving average. This time the 9-week exponential moving average, as you can see on your screen, it is at 19 to 82.79, and the close had been 19 to 65.80. That means only 17 point lower. 9-week exponential moving average for the previous week had been 19,287, and the close had been 19,310. So this time it has closed below the 9-week moving average, but earlier it didn't. Anyway, the fact that the 9-week moving average is very close by gives rise to a possibility that there could be some kind of a bounce back. But it depends, in the sense that if things are bad abroad, especially after Powell's Jackson Hole's meeting speech, in which he said that if needed, interest rates would be raised higher, but that was mostly anticipated, so maybe it would not make much of this thing. But then we need to see that the bounce back is for real. And now we see that the 20-week moving average is around 18,809. Even if there were to be a fall below 19,250, 19,000, and after that 18,800, these This zone between 19,000 and 18,800, this 200 point zone would be a major support area if it were to fall below that. On the other hand, if we see some kind of a bounce back, if that can happen, since in the daily chart, now that the daily chart is on your screen, daily chart, you see that the 50-day moving average is at 19,284, which is roughly, it was the 9-week exponential moving average. So if this 50-day moving average is not taken out decisively and the index gets past at least 19,400 kind of levels once again, then there can be a recovery. But overall, the aborted recovery on Thursday, that is Thursday, it tried to take out the 20-day moving average. Thursday last, it was the 24th of August, when the 20-day moving average was at 19,509. If that were to be taken out on that day and it sustained above that, then the reversal could have happened, at least for the short term. But it failed. It not only failed, it even closed below the 9-day exponential moving average. On that day, it was 19,424. And finally, again on Friday, it closed below the 9-day exponential moving average, which was located at 19,392. So it has fallen decisively below that. It has also fallen below the 50-day moving average. Now, for the first time in this correction, the Nifty is trading below 9-day, 20-day and 50-day exponential moving averages. This is definitely a problematic scenario. And only thing that matters now is the 19,227, the lower Bollinger Band level. If it were to fall below that, then there is every possibility that 19,000 level might be tested, and 19,000 to about 19,800 would be the level to watch out for, where support would come. On the other hand, if it were to get past below 19,500, then it would acquire strength. So probably there could be another attempt at a bounce back, but unless 19,500 is decisively taken out, do not expect much of a recovery. At the same time, unless 19,000 level is breached, this would be more of a range bound trading situation, kind of a week that is we are going to face. Of course, the 31st of August is the monthly clearing, so expect some bearish pressure. Last time when we reviewed, we said that the Bank Nifty most likely would get good supports between 44,500 and 43,500. Exactly, that is the thing, because there had been so much of trading between May and June within this range. That's why Bank Nifty is likely to get more support. Let's see what it has done and how things pan out. How would the Bank Nifty behave going forward? Would it acquire fresh strength? Let's study it in detail. Again, we start with the weekly chart, and the weekly chart clearly shows that here also an inverted hammer line is present, and the upsloping 20-week moving average that was supporting this Bank Nifty. Bank Nifty at the moment, the 9-week exponential moving average is at 44,425 and 44,030 is the 20-week moving average. So the close had been at 44,231. So it is above the 20-week moving average, but below the 9-week moving average. So there are still chances, unless the 20-week moving average is taken out, maybe there could be another attempt at a recovery. Especially there are some bank stocks that are looking pretty good, and even HDFC is a Bank Nifty constituent. There can be some kind of a recovery in that stock as well. That's a possibility. So let's see how things really pan out. After four red candles this week, the Bank Nifty, right from the Monday last, there had been attempts at higher levels, but it could not really fructify, especially Thursday's trading showed that Bank Nifty also suffered pretty badly, and there had been a lot of selling. So let us move on to the daily chart, where we can see how it really behaved. In the daily chart, we see that the Wednesday there was a big run. The big green candle was there, in which we saw a movement of about 500, nearly 500 points, 485 points. That was quite an encouraging move, and mostly punters, traders, commentators, technical analysts all got bullish about that. But do not make this mistake. When the moving averages are climbing down, and there is a possibility of a death cross, that is, both the moving averages are sliding down and the short term moving average is likely to crisscross the longer term moving average while both slopes are down. That means it is a death cross. When that happens, if you expect that the market will post a recovery beyond the going beyond the moving average, or the index, whatever be that index or a stock or a sectoral index like Bank Nifty, it is unlikely to sustain. And exactly that's what happened. The Bank Nifty on the Thursday tried to get past the 45,000 mark. It couldn't do that. It failed. It fell from there and took support on the 50-day moving average. And on Friday, there is a hammer line which actually gives some hope that Bank Nifty might again try to move up. And there are some bank stocks, as I said, that they are looking quite good. So point here is this, that we need to see how things pan out. And as I said while discussing the Nifty, that 31st of August is actually the monthly clearing day. So there can be further fall. Because of bull liquidation. So initially, if there were to be an attempt for moving up, we need to see whether it manages to get past at least 45, 600 kind of levels. If it were to manage to do that, then expect some kind of a recovery. Beyond 45,000, of course, is very good. On the other hand, if it were to fall below the 44,200 mark, then it will most likely test the 44,000 mark as well. And this is a fledgling recovery. We need to see how Bank Nifty pans out. There is some hope that it might do well, but going by the situations in the moving averages at higher levels, one should expect a lot of selling. Hey, did you like my presentation? If it is so, please press the like button. Subscribe to my channel. Don't forget to press the bell button. The bell button gives you the notifications from YouTube whenever we post a video. Hey, we have now come to the interesting part of the stock recommendations. Again, this time there would be two stock recommendations. Mind you, not small cap, not mid cap, they would be large cap stocks, and they at least carry some promise that there would be some kind of a movement that can happen. Keep watching. This week we have chosen two bank stocks as our recommendations. First one is Federal Bank. Federal Bank has closed at 140, and you can see on the weekly chart that is on display, there is a major breakout. The Bollinger Band has been breached on the upside, and there is a green candle The close is near the high at 140. The high for the week had been at 143.80. See, there had been, after a good swing up to say December 2022, when it moved up to something like 136 or so, and thereafter again in January it went up to 142. This is for the first time we see it has posted a higher high, and it has posted a candle, weekly candle, that is above the Bollinger Band range until last week. Now it has actually closed above the weekly Bollinger Band. So this is looking pretty bullish. Our suggestion is that you can buy into this bank stock for a period of 3 to 6 months and your target would be 190. Put a stop loss at 118 on closing price basis. So 118 is your stop loss, current price is 140 and your target is 190, duration is 3 to 6 months. Federal Bank, that's a buy call number 1. Our second and last and final recommendation, final stock study is RBL Bank. We kept the best bet for the tail end. Look at the weekly chart, look at its performance since 2020. It has been moving within a band of around 69 to about 200, 220. Within this range, RBL Bank has been consolidating. It went up, it went down, again it is going up. The most interesting feature is that earlier when it went up or went down, it was nowhere near the 200-week moving average. Now for the last 5 weeks, it is actually negotiating with the 200-week moving average. We have discussed this earlier also. Now it looks very good. This is the time to get into it. Even if it comes down, do not lose heart, because after such a long period of consolidation, accumulation, and this hiatus is going to prove very favorable for the bulls, because it is likely to move up, it is going to go up. Once it starts going up, its first target would be 325, next target would be 370, and finally it would be 395. We are looking at 12 to 18 months for this kind of target range, that is just below 400. Roughly, it would be 80 to 90% kind of appreciation we are looking at. So this is definitely doable by RBL Bank, and take it as a long-term bet. Don't punt on it. Take it as a long-term bet. It is most likely going to reach those levels and not disappoint you, because in my experience I have never seen, unless of course the things are so bad, the banking sector suffers in a great deal. If that were to happen, then a different story altogether. But normal circumstances prevail, we would see a good upswing in this. So buy RBL Bank, put a stop loss below 169 or 165 would be a better stop loss on closing price basis, and expect 325, 370, 395 on the upside. Thanks a lot for watching this video. As promised, we have condensed it, make it more manageable for your time. If you liked it, great. We are very happy. Please come again next week for the same thing.